Hi, I'm Pattu from freefincal. Today, let's take a look at PPF versus Gilt mutual funds and find out which is done better over every possible 15-year periods from August 1994. Like we have been talking in the last couple of videos, we're going to talk about the risk premium. That is, you take on additional risk when you invest in a Gilt mutual fund because the Gilt mutual fund is marked to market. There are additional demand, there is an additional risk because of the market demand and supply forces compared to investing in a PPF. And does it actually provide the reward necessary? And we're going to look at 134 15-year SIP windows, and we're going to convert the PPF interest rates into a kind of a NAV. We're going to call a PPF NAV by just converting it. That is, we take the annual returns from the historical interest rates, and we convert it into a monthly return and build an NAV from that. And if you do that from August 1994, when compared to the IBEX Sovereign Gilt Index, that's how the both of them look like. You get a nice smooth curve for the PPF, but with small changes in slope because of the interest rate changes. But then you also see the Gilt Index has done well since the August 1994, the window that we are looking at. But it has also been highly risky with significant ups and downs. Of course, it's not, you can't take this comparison too literally, because you have to understand that there is a taxation difference between the two. There is a investment limit in PPF, there is not in a Gilt mutual fund. Also, you can't invest every for example, someone might argue, why should I invest in Gilt mutual fund if I can invest in PPF for a 15-year period? That argument to a certain extent is correct, but there will be difficulties with respect to portfolio management, and not every goal can use a PPF, and there are only so many PPFs you can open. So you must, what I would like you to look at it as a risk-free return. The representation of risk-free return can be done or is being done via PPF. That's all there is to it. PPF has its own charm. There's no doubt about it. I'm not saying we should replace Gilt mutual funds. We should replace PPF by Gilt mutual funds. That's not what I'm trying to say. You can have both for certain long-term goals. And like I've just argued a couple of days back, you can use PPF for profit booking from equity, goal-based profit booking, so that you're building the corpus and safeguarding the profits. And you can use Gilt versus equity for regular annual rebalancing and so on. So there are multiple ways to look at it. I'm just trying to point out that Gilt mutual fund is yet another option. That's all there is to it. So if you look at this rolling returns, and you can see here the red line is the PPF 15-year SIP returns. Every dot, there are 134 dots, red colored dots, there are 134 black colored dots. Every dot is a 15-year SIP return, and you can see the PPF returns are gradually falling down, and it is for the first time it has now fallen below 8%, the 15-year return, 15-year SIP return. And the Gilt returns have also gradually fallen down, because they also, both of them are linked to each other. But there are periods when there has been the Gilt returns have significantly fallen below the PPF the PPF return, and some periods where it has done better and so on. But the Gilt return, as you can see, is a lot more cyclic because of the interest rate, the way in which the interest rate changes and so on. But the highest return has always been 8%, which is significant in the past. Even in spite of its falls, in spite of its risk, it has still given you 8%, of course, which is, for that time, it is about 1%, 1.5% lower than PPF. So it has provided a premium for the risk sometimes, but not always. But that's true of equity as well. That's true of gold as well. That's true of any capital market linked asset class. So it's definitely an instrument that you can invest in. Of course, see, when you invest in a Gilt mutual fund, you are saying, look, when I'm investing in sovereign bonds, therefore there is no credit risk for me. But the price you pay for that credit risk is that no credit risk, is that higher volatility. And sometimes that higher volatility gives you more than PPF return, sometimes not. But that's that's a trade-off. That's a reasonable trade-off, because anyway, I'm not saying this is not a PPF or Gilt kind of comparison. You can still use both if you if you can for your goals, and if you have goals for which people always ask me, tell me a long-term debt investment other than PPF, because I have a goal for 10 years, I have a goal for 12 years, I can't use PPF for that. So then the Gilt mutual fund is acceptable, provided you understand the volatility, you know basic portfolio management. Every video the message is the same. You need to know basic portfolio management. But it's not a bad risk premium, but of course there is taxation to consider. If you consider 1-to-1, then PPF, that return, the red line that you see is tax free, whereas you have to pay tax for those black dots, and that will drop down by at least about 1% or so, maybe a little more, 1.5% also. Sometimes it can drop. That depends on the cost inflation index and so on. So there are many aspects to it, but definitely for the long term, your Gilt mutual fund is a worthy option. Long term here means more than 7-8 years. If your investment tenure is much more than 10 years, like 15 years, 20 years, more than that, you can consider the constant duration 10-year Gilt mutual funds. There are a few mutual funds. That's the closest you come to a bond index fund. If your duration is less than 10 years, then you can consider a long-term Gilt fund or a medium to long-term Gilt fund. But these funds may sometimes use other bonds, corporate bonds, up to 20% in their portfolio. So you will have to be a little careful about that, and they will try to play the interest rate cycle game. That is, they will try to guess the interest rates, and as per that they will change the modified duration or the average maturity of the debt fund portfolio. That may go wrong sometimes, and then other funds may perform better than yours, and those kind of risks are always there. So that those things you should be aware of when you invest in a Gilt fund. So that's what I wanted to say in this video. I'll catch you later. Bye bye.